And good afternoon, everybody. This is Michael Filigera. I am with logicalsignals.com and also tradershelpingtraders.com. And this is the Elliott wave update for the S&P 500 for Sunday, June 20th, 2021. Well, the market did continue lower on Friday, as we mentioned, but really has now crossed over a line that if this was a more normal five-wave structure up, that wave four cannot overlap wave one. But as I take a step back and I look at, and this is where wave one completed here. Come on. There we go. There. So the top of wave one was 4,178.25. And we have been down to 41.41. So what does that portend for us now? Again, we've been discussing where this wave three, I'm marking as a completion of a minute, subminute wave three, that in fact, it completed minor five, intermediate five, and primary three. That is a possibility and remains such. And if you remember, as I discussed on Thursday for Friday's trade, that if that's the case, this should just really pick up the speed and start dropping. Well, that's exactly what it did. Now, what I kind of have done is put the four, actually the four should be over here, down here at 4140, actually 4140.75 was the low on Friday afternoon at the close. So the close on the lows. In any case, it could be a four. And I'll tell you why, because I continue to have trouble with all of this sideways garbage that the market put in. And indeed, if it was this third wave, I'll just take a quick zip back here to the 4 hour, that wave three ended in a third wave, and that actually did triangle at the very end, as in a bunch of three waves. So that, if that was a three, would open this up, that this was a three, this is a three, this is a three, this is a three, and we still are going to get a wave five up to finish all of this. Now, the fact that they're all turning into threes and just angling up, so they break the channel more on the downside, but hold this channel and going up because it continues to recover the channel. And that kind of pretends that like we are continuing to form a wedge, and that maybe the high only gets us not much above what we've already seen, and not so much that we're going to fly up here, but it likely will come. If it is going to happen, it should come in a three-wave structure, similar to what we've seen here, but not as long, not as deep or in terms as high. But we have to let the market. So that is a scenario, and it has to stay in the picture for now. So we're not going to be surprised if this market stops and just with the same intensity it just went down, it goes back up. Again, remember, we had a lot of things going into last week and into the month of June because we had the contract rollover, which finished up last week. Then we had the quadruple witching hour, which was on Friday. Everything, futures and options expired. That's now done. But at the same time, we have portfolio managers and hedge fund managers and all of the guys that have to deal with the end of the second quarter and making a report to their shareholders. That's still underway because they've got 10 more days in which to get all that done. And actually, this week and next, that's it. And so it's really 5 days, 10 days. 5 days this week, 5 days next week. In any case, folks, a lot can happen. We saw what they did in the NASDAQ when I presented the same scenario. It's like, well, one thing is if this is going to just keep going down. NASDAQ did not, and ended up going up to 14,200. That would be equivalent of the NASDAQ turning and going back up to 4,300. And of course, that didn't happen. It went down with the same intensity. Now, granted, the NASDAQ made its new high at this stage of the game. It was right here. Stage of the game on and during Globex session coming into last Friday. They only got to 42.20. The NASDAQ made it up to new highs. So there was just ground that wasn't going to cover. And instead, we caught. It was a very strong downdraft here, folks. In fact, let me just take this down a little bit. I want you to see it. It was extremely tradable. And come on, thank you. Yep, nothing to do. How about that time? Yes. With this, now we're talking, these are 50-minute chart. So that's 30 minutes. 30 minutes, it dropped from 42.01 to 41.73. That's a dang good drop in the S&P. And then if you just were trading it as a swing trade, maybe you took profit there, but you got back in because as a swing, you knew it still had more to go. And it did. Not as easily, right? Big rally, decent rally, decent rally. This is off the lows. So it goes down, makes a new low, rallies back up. Goes down, makes a new low, rallies back up. But this one seems to last. Then into the close, bob, boom. And that was pretty intense. So in any case, very decent trading. Now, back to what we can see. So the NASDAQ's making decent moves. The NASDAQ, excuse me. The S&P is making decent moves. Back to the hourly chart. What I need to see now is it's kind of has to light fire. Right now, the hourly, all of those moving averages are pointing down. Remember I told you about this, the 200-day, and I said the 200-day is going to take a little bit longer, but when it does get out of the way, boom, it started to get out of the way, and it went exactly down. So this is another part of what your moving averages are going to help you see. The 200, it's a big boat. It takes a lot of energy to get this thing turned around, and it takes a lot of space. In this case, a lot of time for this thing to turn around. So it is first going to go flat. Then it'll start to curve in the direction that the market's pushing against. And this was down. Now, look at 50 pointing hard down, 20 pointing hard down, 8 and 4, or 5 and 10, however you want to call it, pointing hard down. And that is indeed not a good sign. These will, of course, turn first. They haven't even hinted, but we got to wait for Asian markets to open, then we have European markets, and then it'll be our turn again. So they get to come in and do what they feel they need to do. If this market is going to continue to go down, and I'm going to continue to consider this a fourth wave, okay, then I'm going to put the extensions on there because it's going to be wave A, which I'm putting in here, to the top of wave B, which I'm putting in right there. Here we go. So you can see it's already gotten to 100%, which is the most common. That's the most common. The next most common, folks, sits all the way down here. Then it's going to start to get really kind of painful as I move out to the 4-hour chart, which is going to show me levels better. Then this overlap, if we're coming down to 4,100, all the way down into here, wow, I mean, that's pressing pretty hard. I mean, it certainly cannot break the bottom. And it would look so out of proportion. It already does, in my mind, look out of proportion. So I don't see, but I have to allow for it. And that's why I'm keeping the 4 there for right now. But if it starts to break towards these levels and doesn't stop here, basically even there, then I do think we're going to have to revert and consider this the end. For right now, again, once those breaks happen, it allows me to kind of pull it open and to look deeper. But right off the bat, I think we start heading lower. Then I'm going to have to go back out again to my daily to start to pull what fibs are going to really be coming in action. Because if I have to put the 5 up here, you can see we're completing on many different levels. And it's a serious drop. Then essentially here, we have the May lows that would be next up. And that's still holding us above 4,000. But then if I'm going to leave this as a 4, then this is just wave 1, and this is what we're coming off as wave 2, and then that's really going to be like, wow, we've got some serious upside coming. So we still have all these scenarios, and the only one that's going to be able to make it clear for us is the market. So again, that's why I preach, we must allow the market to tell us what it wants to do. We can only do some preparation in terms of giving some probabilities, giving some relationships between what's happening, and that if it starts to break below these levels, we've got a larger picture we can take a peek at. So if it starts to break below 4,100, well, we're looking down here for the possibility of getting back down to close to 4,000. And we still can work it to where it stops and just absolutely blasts off to the moon. If we then have to go back and look at like, oh, this just completed the first wave up 5 to complete the whole thing. So possibilities, we're going to keep them on the table. Right now, though, I'm not looking real hopeful unless this thing catches fire during Asian markets and European markets, and then we follow through and this starts to come up and break above these levels. Okay, that's what I'm looking for. I'm looking for it to break above these levels. 4,170, 4,170, or called 4,080, 4,090, 4,195, 4,200. This one is 4,215, or 05, excuse me. Then 22. Then eventually up here. That's where it needs to go. Not in all one fell swoop. That's a huge move for the S&P. We've seen it move 100 points in a day, but not on a regular basis. So downside initially should be limited to within the zone. And if it stays above 4,100, it should still be in fairly decent shape if it wants to launch higher. Starts to break down even more, still can launch higher, but boy, we've got a lot of looking at that market to make sure. So downside's limited, we've got that. Upside, we've got our resistance levels it needs to break to prove that's complete, and we're heading into a first, second, third, fourth, fifth wave, ending somewhere up there. That's where I'm going to leave it because we got a lot to look forward to tomorrow. And so I'll leave it like that. We'll let the market tell us. Remember, use your moving averages like I just described. They work in going in both directions. When you get alignment on your hourly right now, and it follows through showing it on the hourly, it's going to show it on the 30, the 15, the 5, the 2, and the 1. And so when it starts to reverse, 1, the 2, the 5, the 15, the 30, they're all going to fall in alignment. You don't need more than the 1, 2, and the 5 to really stay in alignment for you. It's good to have that backup on here because you can see the depth or the strength that the market should produce. So if it's turning, then those are all going to stay in alignment if it's going to go down. But if it's going to turn and go higher, your 1, your 2, and your 5 are going to come into alignment first. And that'll keep a trap and keep track of that upside move. And then again, you're going to be able to track the pullbacks so that you're able to count all the way up. And your moving averages should help you do that. More on that if you come to the trade room. If not, the next update will be Monday, June 21st.